Welcome to this walkthrough of the updated mobile app financial model template from efinancialmodels.com. This is a template we have recently updated, and I would like to walk you through to explain you a bit how this spreadsheet works and how to use it. A link to the spreadsheet template referred to in this video is included in the description below. The purpose of this spreadsheet template is to translate a business plan for an app project. It can be a mobile app, but also any other desktop app which can be installed, so that you can translate the business plan into financial projections and basically based on these financial projections determine if this project is financially viable, and also be able to present it to capital providers and explain them what's the upside and what are the risks associated with it, so that they can better understand how the economics work of your next venture. The way this spreadsheet is structured is we have summary sheets which basically summarize the outcome of the whole forecast, either in a condensed form or in an extended form. We have here settings page and assumptions. These are used basically to populate the whole model. That's where we do most of the work. And then we have calculation sheet. We have one sheet which basically runs through the numbers to develop a monthly forecast. We have special analysis to determine lifetime value. We look into subscriptions. We aggregate the financials into a yearly forecast. We do a break-even analysis. We look at investors' cash flows. And then there are also tables with some terms and abbreviations, and also lastly some more instructions. And as you can see, we are using these cell colors. So blue, these are the inputs. That's where we want to do changes. If it's light blue, this we can also change. It means it's just linked to another input on the assumptions. So let's get started. And where we get started is on the settings sheet. You can see here on the left that we have a navigation menu. So we can quickly, for instance, we can just jump and we can get to the section, or we can go back and go back to the main navigation menu. We have here a section to do model checks. In case something would not work out, it would indicate where the problem would be. And then the rest of this sheet are basically all settings needed to calibrate the way the model works. We basically say what's the first forecast year, which month we get started. In case it's not the first month of the year, we can get started somewhere during the year, cash flow dates. And then we can also set the labels. We have here various sources of where the app downloads come from. So these are the guides, what types of download we foresee in this model, but we can also change the labels. Another feature is that we can include or exclude each source of downloads. We can include or exclude, and as you can see, if it's excluded, this one is zero downloads from here, and then the rest is included and then adding up. So we can basically run simulations what happens if we include or exclude. The same logic is true for the sources of revenues. This model has up to 9 sources of revenues, starting from selling a paid download, or basically a paid app version, then selling subscriptions, in-app purchases, or then also other types of transactions in case you run a small marketplace inside your app. So you foresee up to 2 of these revenue models. We have revenue models also foreseen for ads, pay-per-click or impression ads, other income, and all this. So here the same logic. We can either include or exclude each source of the revenue, and then it will impact our financials. And for instance, let me shortly demonstrate that. Let's say we would exclude everything but subscriptions. We jump back, and you can see this is basically business plan. We get a business of $8 million. If we change the monetization strategy and we go for basically all of these revenue streams using the assumptions, then you see this will give us a different size of the business. So this allows us basically to configure our model, which scenario we want to run, which revenue streams we want to include, which download sources. Then we also have here settings. This is basically to calibrate a bit these, especially the transaction sources. Do these transactions depend on active users, on installed app subscribers or vendors? I'll get to that, but here we can basically change the dependencies. Then also some of these revenue streams, if we sell these services, they are being sold either on your website or in the app. And these sources help us to further calibrate if this is subject to the commissions of the app stores, yes or no. So we can either set this to true or false. And then also some first business assumptions, starting with the inflation rate at which the costs are expected to rise. Subscriptions, if you want to book subscription revenue in the month they appear, so it's a pure cash-based view on your business, then you can put that to no. But for instance, if you receive a 12-month subscription and you want to actually book it and allocate all these 12 months, so then we use this option so that it's then allocated or basically split and allocated to each of these months this subscription occurs. Then we have some placeholders here for net working capital, depreciation, taxes, when to start dividends. Here you can see we do that in year 6, and we would basically pay out all cash which exceeds this threshold here. If we don't want any dividends, we simply put this to basically to a year nowhere. As you can see here now, dividends are excluded from our forecast. Let's go back. Then we also can set an exit valuation multiple and basically the year when to exit. So let's say we want to exit in year 6, or let's say in year 10. And in year 10 we are exiting at the EV EBITDA multiple. So here we can basically set all these type of multiples. Let's say we want to use only 7 times. Then we would exit at 7 times EV EBITDA multiple in year 10 in this case. Then some more assumptions. Basically, if you have paid ads, in which months you're going to spend. So what we do is we take an annual budget and we say how much of that annual budget is spent in which month of the year. Same for OPEX, depreciation, amortization, tax, dividends, etc. So this is just to allocate costs. As you can see, CapEx, we normally would basically assume at the beginning of the year. Software development costs, they basically are more ongoing. We would be spending those basically during the year. Now let's look at the assumption sheet. This is a big sheet, so if in case you get lost, simply jump back through the navigation menu. And here you can see the sections where we have. So basically we first need to define the download sources for the app, the user metrics. We need to calibrate some of the conversion rates, source of revenues, cost, funding, investor assumptions. These we all need to calibrate. So let's jump in here. We start with the sources where our downloads come from. So one option is basically to use word of mouth downloads. So let's say if we have active users, how many of those they're going per month, they're going to give us referrals. And this would allow us to basically include downloads from word of mouth referrals. That's one way to which downloads can happen. Another is simply organic activities. So we say, due to our marketing, every month we should get 100 organic downloads, and then how is this number going to increase going forward as we develop our brand and we become more well-known and might attract more visitors. So that's another way we can forecast our downloads. Another one is influencer campaigns. How many campaigns we're running per month, what's the target audience, what's the download conversion rate, and we can forecast, run the numbers, can forecast how many downloads we can get when doing this. Social media posting. So here we need to know how many views we can get. and how is this number to grow, and what's the conversion rate, meaning download conversion, how many people are then actually going and downloading the app. If we have an affiliate program, so we can also model that. So we can say in which month we're going to start. If it's not the first month, sometimes this happens a bit later. How many affiliates we start in this first month, and then how is this going to grow. So if we start with 5 and then per month we grow by 20%, so we basically grow to several hundred affiliates in the next years. Each of these affiliates will give us per month a certain number of downloads, and then we can also forecast another source of downloads from affiliate marketing. And lastly, the model foresees basically to also use paid ads. So here we have a budget. There's a line in the download costs where we foresee what's the budget needed for paid ad marketing. And this budget we then say what's the cost per click, how many clicks we can get, download conversion rate, and so we can forecast the number of downloads from paid ads. What we get then is a summary how many downloads this all adds up to. And as said before, we have here an option to actually exclude certain download sources. So let's say if we want to run a different marketing strategy, we can then simply include or exclude, and basically you see if we would only include these two sources of downloads, this would look very different. So it's really worth to think about where the traffic might come from, if we have an affiliate program or not, and then basically this will add up to the expected downloads we can obtain as per our business plan. Downloading the app is one thing. Converting them into users, that's another thing. So what we need to look through when we receive download is first the uninstall situation. There might be people who, when upon downloading, they directly delete the app, so they are gone. Also, people who are not using the app for a long time, they might also just basically uninstall the app, and they might also gone. So this means we need to take this into account, and what we want to figure out is how many people actually have installed the app either on their smartphone or on their desktop. Installed doesn't mean that they actually use it. From the number of installed apps, there's a certain percentage which actually turns to active users, means they use this on a regular basis. Here the definition is yours to define. For instance, this could mean, are these people using the app at least once a month? But of course, the definition always depends on the business. But important is we need to know who actually is using the app on a regular basis. Once we know the active users, a certain percentage of these active users can be converted into subscribers if we run a subscription, if you have a subscription offer. So that would be a conversion rate here. And as you can see, this can also change over the years. So this means here we find ways to convince people to convert to become a subscriber, and we get better and better at doing this. So normally this also assumes a bit an increase in the conversion rate. Then we have here another category. This is a category which is a special subgroup from either active users or subscribers. And depending which one you choose, in this case active user, we say that, for instance, 5% of these active users become vendors. And in our case, this would open the grounds for that these vendors actually can use the app to sell certain items via the app, and then we could generate an income fee from these type of transactions. So we need to know how many vendors actually can we obtain by linking them to the forecasted active users. Now this will give us the user base. We have defined it now very clearly in different groups of users. We know now the user base, and now what we need to do is to figure out how can we monetize the user base. As you can see in this template, we have foreseen a variety of sources of revenues. Here we start, for instance, with paid app version. As you can see, this is not included. Let's shortly include that. So let's say we would include that. How would that look like? We say we have here free downloads and we have paid downloads. So 20% of the new downloads would be paid. And for instance, they would have to pay around $5 per download. So we simply multiply the number of paid downloads by $5, and this will give us an income stream here. If we see that we don't want to do it, we can just exclude this income stream. Then another important source for many apps are subscriptions. This model foresees a 4-tier subscription model. We have a free plan and then 3 paid plans. The paid plans have different pricing assumptions, and also the type of subscription we're offering. There are discounts included. The longer you subscribe, then you can assume a certain discount, and you can of course also change the discount so that you give a bit less discount if somebody goes for an annual plan, but still should motivate users to subscribe longer, and then you actually also have more visibility on your revenues. Then we start looking into other types of revenues. The first one would be in-app purchases. If you're using the app and there is something offered to buy. So the question is, are active users, how many times per month they're going to buy something? There is whatever figure this is. This gives us the number of app purchases on average. We multiply by the average active users. We have the purchase value at which we are selling this, and then this gives us a revenue or income streams from in-app purchases. In this model, we have further additional transaction type of income streams. In this case, we make money from a fee of transactions triggered here by average users who purchase items offered for sale in our app, and we generate a fee from the sale for brokering a sale for these items. Same for a second type of transaction income stream. In this case, we can say that either these items, you can also say by whom they are triggered, either from active users or also by vendors. We could switch that to vendors here. Let's go back. So the vendors, we have a number of vendors, a certain number of that is participating. They run certain promotions per month. What's the value per promotion? And then we also can get monetize via applying a fee for such promotions. Furthermore, there are also pay-per-click ads, impression ads. Here are just the assumptions in blue to forecast, and then these apply for the different years going forward. An additional user-related income stream, simply we select which type of user category basically leads to an additional purchase income per month, and then we can also forecast another income stream, and as well as a placeholder for other income streams. Then we continue calibrating our model, and we have here CapEx and software development costs. These items here are going to be activated on the balance sheet, so that they are separated. We go into direct costs. The question here is if we are subject to App Store commissions, so we have to define where our items are going to be sold, either via the App Store or our website. So depending on these channels, we either have to pay commission or we don't. And you can also see that this can change over time. So if we manage to get away from the app stores and we do the purchase via our website where we're not subject to permission, then these app store commission costs, they might stop at one point. So it's also one way to optimize our profits later on. We have to pay to getting downloads. So we have here all these different download channels, which we went over beforehand. Either we apply a cost for each type of these downloads, or for instance, paid ads. Here we have a budget we have to spend. For influencer campaigns, the question is how much we have to spend on average for one campaign. And this all adding up gives us the download costs. Then there might also be a cost related to the user base. So the more active users we have, they basically could also lead that we have to pay proportionally more costs. So either we can do this by by these three user types, we can foresee a certain cost to be charged, or just we can group it together. And so if our user base grows, these costs also will grow. Purchase costs, these are related to the number of purchases. Here, basically, we can either on a per item purchase, so these types we can select and then apply a cost, or dependent on one of these income stream as a percentage of revenue, and we just apply also for the costs. So it's all also counted here and then added up, and this in this model are basically the components of the direct costs. Then the next item we need to think through is our staff. So what's our staffing plan going forward? How many people we're going to hire? What's the average salary levels? What are the employee expenses? This goes into operating costs. And then we also come directly here and we can put up a budget. How much are we expect these items to, how much are we going to spend on these items in the next year? So we either can do this detailed line by line, or if it's getting difficult, then we can stop here and start using this. And for instance, as you can see, then we will just apply a percentage of sales in case we want to link it to the revenues. If not, we just go item by item. Then the next position we need to think through is how many funding rounds do we need. In this case, you see we have here 4 funding rounds foreseen, so we can either use all of them, or we can say, okay, we just go for 1 round. How would that look like? So if you only go for 1 round, then it means we calculate funding required. We have here the positions in this case. And then we can also basically split the fundraising a bit more into, for instance, in this case, in 2 steps. So let's say here we want to go for 600,000. So we go here for 600,000. There is a trigger, which is a cash buffer. So we can raise a bit more. So we use this normally to round the equity amounts. And in this case also, let's say here we go just for 1 million, and we just take the cash buffer. So we would need here 600,000 and 1.6 together 1.6 million. And if we just to show you, if there is no cash buffer, then this is what is really needed, but it also means that the cash balance will basically get 0. So this is done. Then we look at the investors. We have a set of investors. So we have here founders. In that case, we have, let's say, 2 founders. They have, before we start this model, they own the company 100%. Then the question is, for each round, how much more equity are we going to issue? So if you issue 20% to seed investors, founders become diluted, it's taken into account. If we have a second founding round and we issue another 15% in total, then everybody else from the previous rounds also get diluted. And so we can get a small cap table to obtain visibility on who is owning how much of the company. Then we know this is how much funding we need. Who is going to pay for that? In this case, this will come from seed investors. This will come from Series A investors. These are the 2 funding rounds we include. In case the founders already invested or put up some money by themselves, we can enter it here. This is before the model takes into account. And now we have also the value needed, which we need for pre and post money valuation calculations. So we know first round 600,000. For that, we're going to issue new equity stake of 20%. Where is that coming from? That's here. That's going to be issued. So this is 20%, so meaning post money 3 million. And we're doing the same thing also for the next funding round. Here's 15%. We're raising 1 million, so the valuation gets higher. And what we want to understand is a bit, where are these valuations going to go? So we can see a bit if that might be realistic or not. And then what we also want to see is, now we know how much equity and how much money these investors need to put up. So we want to, basically we calculate, we have here a sheet with investor cash flows, and we calculate through investor by investor. investor, and then what's their participation, in this case just from exit, what's their IRR, so that we can make sure that our proposition is makes sense. And you see here that we get 33% IRR and here 30%. So seed investors get a bit better deal than the Series A investors in this case. So this is all the assumptions we need to calibrate the model. It's just to work through this sheet. But then what happens is that we take these assumptions, we plot it on a monthly timeline, and here we have month by month figures for basically 5 to 10 years. And we go also here, have all the sections. If you want to just go through, you can see this all the sections. And then we also are building the monthly P&L, monthly balance sheet, and cash flow statement. And here is one tip. Here we can also see how the cash balance is going to develop over each month, basically. And we can also see when the financing is being injected. So if the cash balance gets low, we know, okay, now we need to inject more equity, and we can basically go back here and work with the funding assumptions. In this case, we can say we have 2 rounds, and we can also move when we want to do the second round, if it's in 7 months or if it's in 13 months. And then the model calculates this all through, and also adjusts the size of the previous funding rounds, because now it needs to last, in this case, 12 months, while before it was just the capital was needed just for 6 months. These monthly figures are then aggregated into a yearly forecast. Now we basically take and see a year's end what the situation is, what's the total of the 12 months profit and loss, and we basically form the yearly financial forecast, which then also results in a free cash flow forecast and all the KPIs we are interested in to basically to follow. With that said, we now have all the figures calculated, and now what we really need to do is to go through the summary sheets and check one more time if this all makes sense to us, where the downloads come from, what will be the foreseeable number of users, the expected P&L from monetizing our app. If we want to change something, as said, we can just go to the settings page and include or exclude certain sources of revenues. We then also have the breakdown where these revenues occur. Let's say we don't have paid app income. So what we can do is we can just exclude it, and boom, that's done. So only revenues from other sources in that scenario. We then also have some more analysis here, so we can understand for 1 year what's the expected revenue per active user. Or we can also, instead of active user, we can, if you're interested, if it's more a subscription focused business, we just change here the point of view, and then we can calculate per subscriber what's the expected revenue, what's the expected gross profit, and EBITDA. And let me turn this back now. We have another look at the customer acquisition costs. Either is calculated per download, per active user, or per subscriber. If it's further advanced here, this goes up because it's more difficult to get the download coded in an active user and subscriber. So if you have a subscriber, this is much more valuable than if it's just a download. So that explains this difference. And we can then also see how these customer acquisition costs going to develop. And this basically relies on our assumptions here. If we go to customer acquisition costs assumptions, this is mostly these assumptions here. So if you change the cost to get a download, this will basically impact the cost to acquire a new user. We also can have a look at the situation from how the balance sheet will look like, financial ratios, the cash flow statement. We have here a section which details the break-even analysis. As you can see, This basically changes. Every year we calculate how many active users are required for break even. So you see this number always changes. Let's now put this back here to year 3. So this is year 3, and what we can see here is this is the number, the break-even point, 50,000 users. This is what we have in the business plan, so we should be profitable in year 3 because, let's have a look here. Yes, we are profitable. Basically, we are profitable from year 2 onwards. So if you go back to break-even analysis, voila. So you can see only in year 1 is basically where we need more users than what we foresee in the business plan. So no, there's still a way to go. Here we are just at break even, so this is hard to make a profit. And then the further we go, we can better allocate our fixed costs, and then we should be profitable in this scenario. So either break even can be calculated on the number of users, or you could also change here subscribers or installed apps, so we can get some good insights depending on what we're interested in. Or we can also look at the average price. So here, average revenue per active user. So we need, in order to break even, we need the business plan assumption in terms of number of users, but these users need to basically generate $26 in revenue. And here we are also in year 3. And as you can see, in year 1, we have less users, so they would need to generate much more revenue. So it's still a bigger gap here. Here it gets closer, and then as we go, we basically monetize the app. Give us some insight. What's our risk? Are we close to break even? Do we have some buffer, or is it very far gap? What would be needed to make this business break even? And this can then hopefully help us to optimize our business plan. Then we have a financial feasibility section here summarizing basically what's happening on the free cash flow side. So see here, this is the free cash flow forecast. We have here an exit valuation included. So based on these cash flows, we then also can calculate the relevant metrics. And as you can see, this business plan seems highly profitable, leading to attractive returns. But we can also see here what's the underlying assumption in terms of when the exit happened and what the exit valuation might be. And of course, this is just an example. You can just go and basically set the assumptions you believe apply most. You can also select a different exit multiple for changing more to revenue multiple or an active user multiple, and just enter the respective assumption here. Let's say we go active user. Let's say we would value this at $50 per active user. What would be the result? And then we get a different exit valuation here so that we can run this scenario. What this chart will tell us is how we forecast, based on this multiple, how we forecast the business value to develop. And as you can see, as the user base grows, the business becomes more valuable because we apply this multiple. Then another last recap on uses and sources of fund. Here we have 2 funding rounds, and we can then also zoom in and either look at the total, or we can look how the money is spent on round by round. In terms of the monthly financials, it's a bit cumbersome to go through all this sheet here, so that's why we aggregate most of the figures into the yearly numbers, but we could also have a deeper look on monthly financials, and we just select which year we want to have a look. We see here the P&L, we see the cash flow, and we also see the unlevered cash flow and also the cash balance. So for instance, year 1, because we have some funding raised at the beginning, and we're also raising here, so basically we're not running out of cash. So this is summarizing what we expect to happen in this selected year. Here then also recap again on the investor summaries, how much is going to be invested, what equity stakes are being issued, how does the shareholder structure look like, and what will be the expected returns per investor. Then we have here a table which gives us the sensitivities. It is to be set, this needs to be updated. These we'll need to change the calculation settings to automatic. We need to select, give a small push to the model, and then the figures, all the tables are updated and recalculated. Just wait until this is properly updated, and you can then see which of these assumptions are having the highest impact on the value of the business in terms of IRR. Then another topic we have not talked about is the customer lifetime value. As you can see, there is a sheet here which runs all the calculations. So basically the question is, if you have one user, what's the lifetime value of this user? And best is to go here on the summary sheet, and we can basically see what's the lifetime value of a download or of an active user. And based on our calculation, we can see the value in this case if you have a user which is active, the value should be around $74 in that example. Here's a breakdown where these money should come from. And then also we can see the timing of the money, of the income received. And as you can see here, nearly half should be obtained in the first year. And then as users on average start to uninstall, this normally goes down, and the rest of the value is then captured over time. Customer lifetime value is not a static number. It's basically is dependent on a range of assumptions, and these assumptions, they change in our forecast year by year. This also means that our lifetime value actually is expected to increase. So here in year 2, this is $75. We expect to do a better job in increasing conversion rates, in basically keeping the users engaged on our app, and basically in this way to better monetize our user base, and this should also lead to higher lifetime value per customer. So as you can see, this is quite a comprehensive model. You are free also to run these scenarios and to change the assumptions many times so that you can really understand and run scenarios and see how this business might develop over time, to give you an idea how this is, what this business could turn into, and what this also means from a financing point of view, how much funding you require. And the idea is that this model gives you comprehensive figures so that you have a better grasp on the financial prospects of your venture. I hope this walkthrough was useful. If yes, please give the video a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.